Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon, trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Counsel Incorporated. Welcome back to the show, Danielle.
Hey, Jim.
Danielle, on your blog Juggling Dynamite, coronavirus not the cause of the recession. What is?
Well, it is something I've been talking about for a while. Coronavirus is a trigger, it's a catalyst to bring a bunch of things out into the fore, but it's not actually the only source of our economic problems right now, right? The fact is that we came into this crisis at the end of a decade-long credit expansion period when people were doubling down on speculative activities rather than building up savings for a rainy day. And so Canadian households infamously, of course, have the highest debt to disposable income of pretty much anywhere else in the world other than Australia. Our home prices are the most outrageous in most parts of the world. They're certainly the most expensive of all of the G7 by a long shot. So these trends where we sort of were, when the oil price collapse hit in 2008, rallied into 2011, that was an opportunity there for us to really get serious about diversifying our economy into new technologies, services, and systems. And instead what we tended to do was just double down on how do we get more people to borrow more money and consume. And really that's what happened in the last decade in spades, and all of our GDP growth became dependent upon an ever-escalating real estate sector. That's why you've got the CMHC head, Evan Siddle, who's come under fire from the real estate sector for saying things like, it's not good to keep lobbying for less and less down payments and laxer and laxer lending because, we're already in a hell of a mess. And so we always knew that some shock would come, and coronavirus is certainly that, but it's not, something that was completely unforeseeable. The other thing is that we had this expansion in the stock market that has been very wobbly for the past few years, and every time you get a downdraft in prices or mean reversion where there's some price discovery actually happening because earnings were slowing, because revenue was slowing, because the global growth has been weak, all those things, you had this, knee-jerk reaction by central banks to pump liquidity into the system, which enabled companies to buy back more and more of their own shares, which we've talked about many times, but that just meant that companies too came into this downturn with the highest debt levels in several decades, with the least amount of cash and savings, doing all sorts of short-term sighted activities which were about goosing share price rather than building long-term productivity and efficiency. So we see that with, there's a big decline in their investment plans. And then year to date, with the cash crunch that hit, they've also dropped their buybacks. So this is typical, right? I've mentioned this many times. It's not bullish when companies are buying back their own shares. Typically, it's a sign of them having excess funds they don't know what to do with because there's not a strong economic case evident for where they should be investing in, materials and factories and employees. And so what they do with excess liquidity in those times is really financial gimmicks, and that's what they did. So they were buying back more and more of their own shares as prices were the least attractive in over a decade. And then as prices plunged into March, of course, the panic hits because people realize how levered they are and how little they have prepared for any kind of dislocation. And so rather than buy low, they tend to, just freeze their buybacks and sit and try and figure out ways to raise cash. So the central banks stepping in the way they have in the past few months has definitely enabled companies to borrow more. But again, because they already had a lot of debt, that's really not that helpful. If they put that cash in the coffers, it can help them perhaps to, zombie through a little longer. But we're already seeing that, there was a study out of the University of Chicago, I believe it was, this month that said that they think 40% of the layoffs, for example, that have happened from coronavirus will be permanent. So, I like to describe this crisis as something it's a sort of a series of slow-moving crash, So the first was the incoming virus, the denial and everybody thinking it was no big deal, till all of a sudden it was a massive problem in the first quarter of 2020. And then you saw the reaction to shut down, the tank in the economic growth, the fastest plunge in the stock market that we've seen, where it dropped so quickly in 1 month. The next phase, of course, is where there's reopening efforts, and you see some bounce off the bottom. So some jobs come back. You get a rebound in consumer spending because of all the government intervention and checks that were sent out to people, which allowed them to, go and consume and buy things a bit. It also, a lot of people are indicating that they're saving that money or using it to pay down debt. The behavior of the consumer is in flux right now because people have sort of understood that they're in this precarious position. But basically, the second phase is that rebound, which we've had since March, where economic data looked, from a depression level to a deep recession level, coming up off the bottom, and you got that V rebound in asset markets where, basically a handful of technology stocks in the U.S. went parabolic. Tesla, Apple, Microsoft, these things, Amazon, really have been the right straight off the bottom up a ridiculous amount in the last few months. Everything else pretty much treading water. A lot of stocks have not come back anywhere close to where they were at the peak in February. In Canada, you've got a similar predicament where we've got the mining shares have really rallied strongly in this environment. But all because the U.S. dollar has weakened. So this is the thing that people forget. And this is what's been driving this next phase. The second phase was that, all the largesse that the federal government in the United States pumped in, the weakening of the dollar, boosted commodities, boosted commodity producers, boosted risk assets in general. Now the third phase, which I think we're about coming to now, is where the revelation is that we haven't come into a recovery. We're still in a very deep recession. That a lot of the jobs that we thought were temporary layoffs are in fact permanent. That a lot of the businesses that we thought were temporarily closed are in fact not coming back. Where debt has gone, toxic levels all over. Where taxes will have to go up. And where the U.S. dollar is very likely to find support and start to bounce again. And once that happens, then all the wheels come off the risk cart once more. And I think that the financial markets will be in for the next round of this bear market.
We'll have more with Danielle Park right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Danielle Park. Danielle, on your blog, Juggling Dynamite, another article, Reality Check. Making back losses is not the same as making gains. That seems to be obvious, but I think a lot of people don't think so.
Yeah, no, it's it's something that people who are pragmatists and aware of the actual math and numbers of things keep their eye on the donut, not upon the hole, as so to speak. We are aware that people are, celebrating this rebound from the sharp V drop into March. But the fact of it is that most stocks, as I said, have not recovered. So people go around quoting that, that everything's bounced X amount, but in fact, if you look under the hood, you notice that things like the Canadian financial shares are still off over 18%. The REITs are off almost 30% still. The energy shares are still negative 44. So even though the TSX has bounced, with, as I say, the miners under the hood, the reality is that the miners are now just back to where they were in 2011. So this has all been part of this secular bear, sideways moving. You get some ramp, as I say, on exuberance over central bank liquidity injection speculation, but it's really just been one trade after another trade after another trade. Nothing really systemically robust going on here, and that's why there's been a lot of head fakes. So people get sucked into thinking they've missed out on something, and they're desperately buying again, or those that cashed out, and were very pessimistic in March. There's a couple of camps there. One, people who cashed out realizing they had too much risk, devastated by the losses that they suffered in the first quarter. And instead of adopting discipline then and seeing the error of their ways, they become these, obsessive, trying to buy back in at any price people. And, then the people who are always bullish and are always talking about the big returns for the stock market, the people that tend to sell us the products that are linked to the stock market, and that's how they collect their fees, they're always talking it up. Of course, they talk about buying opportunities, they never talk about selling opportunities. So as they quote what things are up from March, the question should be, and how much of that had you sold before things dropped, and how much cash did you have to put back to work? And the answer is almost always next to nothing, right? So, the fact is, we've been in this secular bear that began in 2000 from extreme valuations in asset markets, over-exuberance, rampant speculation. We've been in that period now for 20 years. It's been a sideways range. There's been a couple of meaningful bottoms in 2002-3, 2008-9, where you could actually have a cyclical buy and, some prospect of reasonable gain on a fundamental basis. Dividends, capital gain was probable, all that sort of thing. But it always runs its course in a fairly quick manner because we've been in this declining growth environment, and high debt is restraining the potential of the economy. Each time they add more credit, they're just, making it harder for us as we go forward. So really, a bear market is born of cheap prices, such that the upside is much greater than the downside. We are nowhere near that today. We are now back to the most extreme valuations since 2000. We are comparable to that in many ways today. So we have accomplished really nothing in terms of improving prospects for capital at this stage, other than it's been 20 years. A secular bear typically is 15 to 20. So we're probably in the final throes of this next and last bear market, which will ultimately crush the animal spirits and take values back down to where there's some sort of math sense to what's going on, where they reconnect with things, where housing prices, for example, reconnect with things like rents and incomes to make them affordable for the masses, where, earnings and sales start to reconnect with prices again of securities, where credit quality matters. So really this opportunity is huge for people who have a fiscal discipline, who don't get, grabbed by the madness of crowds, who can control themselves and realize that, this fear of missing out business is a total devastation over the long run. What ends up happening is people who are holding long at these extremes or buying back in at these extremes just set themselves up for a decade of going nowhere thereafter. And we've seen that repeatedly. Every secular peak in these readings, when people are just indiscriminately gambling, basically, they spend the next 10 years or so just trying to get back their money. And although they will be quoted as positive returns, the reality is, as I say, just growing back your losses isn't the same as actually compounding positive gains over time. And that's, we're in the business of trying to not lose, and actually making positive gains year over year so that compound returns actually can add up to something. When you're in an approach that has none of that discipline and you're just, got a tiger by the tail all the time, then you're tons of volatility, tons of risk, and your end result is very, very little compensation. In fact, over the last 20 years, less compensation for all the ups and downs in stocks and all the devastation and euphoria. They have underperformed holding just GICs and bonds over that period. So, and they're a fraction of the volatility. And I don't mean corporate debt. I mean treasuries from the government of different governments in Canada as an example. So it doesn't take a lot of complexity. I think the next trade here that I'm watching very carefully, that will be the foundation, the underpinning to everything that happens next, is the U.S. dollar. So the Canadian dollar, we covered our longs on the U.S. dollar in March when it was trading about 145 Canadian. We locked in capital gains there, and we're waiting for an opportunity to buy back U.S. treasuries again. So this will be U.S. cash-based instruments that, not the stock market at these levels, but somewhere in here around 90 on the DXY, which is the basket of currencies relative to the U.S. dollar, primarily the euro, which has been incredibly overbought in this environment on a trade again, and the U.S. dollar versus the CAD, which somewhere in around this area of 130 could provide another re-entry point, in which case people could make some capital gains again without having to go into a stock market that is probably about to have its next leg down in an ongoing bear market that could last potentially for another year or more.
We'll have more with Danielle Park right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Danielle Park. Danielle, another headline from your blog. Canada's anemic economy. Can we get out of this hole, and do we have any bright prospects out there?
Well, that was Nouriel Roubini, the famous economist. He was talking to BNN this week, and he was just talking about what we have going for us in our economy and our headwinds. And we're a fairly broad-based economy. We have good household wealth. We have well-trained workers, an educated population. We have, generally good health relative to many places in the world, thanks to our healthcare system. However, with this pillar of energy being so much in flux and risk right now, again, the price of oil is still around $40 a barrel here. Yes, it's bounced off the bottom when it was trading for negative carry there for a bit in March, but this is again not the price point that many of our businesses or economists have factored in for Canada going forward. So we're writing tons of checks for the emergency response, and we're likely then heading into a time where we're going to have difficult time finding revenue in many of the traditional sectors, and we're needing to increase taxes on things like corporations, possibly on capital gains. We have to somehow figure out ways to get money in the pot. So he was just talking about that being a headwind, for Canada going forward. And commodity producers in general, commodity exporters, Canada is in that camp, and 30% of all of our Canadian GDP is exports, and a huge amount of that, of course, is in the commodity space. So we need to find other products and services. Quite honestly, this is part and parcel of the massive debt bubble that has happened in the last 15 years, where so much debt was added, so much consumption was elevated because of that, and then in the bursting phase, we are moving to probably, a much lower consumption level around the world. There's a lot of stockpile. There's a lot of excess capacity in the system. And so the demand for our goods is going to be weak as a result. And we only have about half of our economy that's dependent on consumption domestically, which is better than some places like the U.S. where 70% is consumer demand, but worse in some ways too, because that means we as a population don't have sufficient consumption ability to drive more than half of our economic growth. And so we are reliant, or we do have a gap where we have to look for how can we, still have products that are in demand in the world and at what prices. So this is, we're this is not something we're going to fix quickly. This is a long slog. Some of us have been talking about this for 15 years, just noting this hole coming and saying, hey guys, are you paying attention? Because, it's great right now, but we're heading into a totally different environment where the world is moving to different energy sources, different ways of doing business, different ways of producing goods, and we're not really setting ourselves up properly to be the benefactors of that. And anyway, but during the good times, of course, most people just want tax cuts and spend and not worry. They don't like to save. They don't like to build up the coffers. And unfortunately, that's why we're in a weaker position now.
Danielle, thank you so much for chatting with us.
Hey, thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite, her website jugglingdynamite.com. If you have any questions for Danielle or any of our other guests, you can send them to info@howstreet.com. Our YouTube channel is Talk Digital Network. Find us on Twitter @HowStreet. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.